Hello traders, welcome back to the Forex Geek, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the Fibonacci Pivot Points, a powerful combination of two proven technical analysis methods. If you are looking for a way to pinpoint accurate support and resistance level, identify potential market reversals and refine your entries and exit points, then this strategy is needed to be mastered. So stay tuned until the end, because I will break down exactly how to use this tool to create a step-by-step trading plan tailored for success. So let's get started. We start by understanding what the Fibonacci pivot points are. And the Fibonacci pivot points are technical indicators that combine standard pivot points with Fibonacci retracement levels. This unique combination helps traders to identify precise support and resistance zones, making it easier to anticipate potential price reversals or continuations in the market. So this is our Fibonacci pivot point. We said that these green sides are our support regions, our support 1, support 2, support 3, while the red areas are our resistance 1, resistance 2, our resistance 3. Being plotted using our Fibonacci number tools on the chart. The Fibonacci numbers, this is plotted using the Fibonacci numbers on our chart. Now, how do we trade using the Fibonacci pivot point? We'll have to use a step-by-step guide to using the Fibonacci pivot point effectively for our trade. First of all, we start by applying the Fibonacci pivot point indicator to our chart. Most trading platform allows you to add this indicator directly, or you can calculate these levels manually using formulas discussed. You can use the 4-hour or daily time frame for a more suitable and reliable signal, as this time frame tends to filter out market noise and provide a clearer market structure. So using the 4-hour time frame to get a better understanding of this indicator. Now, these are our resistance 1. The first line here, resistance 1, resistance 2, resistance 3. Sorry, support 1, support 2, support 3. While this green line here are our resistance 1, resistance 2, and resistance 3. The second step is to identify the market bias. You determine whether the market is trending or ranging. And as I can see from this area, the market is trending to the upside because price broke structure at this area, signifying higher prices. So we are trending to the upside, making series of higher highs, higher lows, higher highs. This is basically how we are trending in the market. After we have determined our structure points, if price is above the central pivot point, this is a bullish bias. Now, when price is below the central pivot point, we are in a bearish bias. And at this area, you can see price is above this area. It is staying above this pivot point area, this support area, signifying we are in a buy scenario. We have to wait for price and monitor price. The step 3 is to wait for price action at key levels. We have to monitor price behaviors at these Fibonacci levels plotted on the chart. We monitor price when price gets to our R1 or S1. When we see a breakout through the R1 or the S1 with momentum, this is what we are looking for at key levels. Then for a reversal, we wait for price to either reject the R2 or the S2 with wicks or reversal candlestick pattern like pin bar and engulfing candlestick pattern. This is how we expect price to reverse. And as we can see at this area where price broke structure, when price came here to retest, it came to reverse from the S1, the S2 region, forming a pin bar. This would have been a particularly good area for us to enter our buy trade. Now you confirm your move. You confirm the breakout or the reversal using additional indicators like your volume. You can use your volume or you can use your RSI. And as you can see at this area, when price broke out and came back to retest, it was accompanied by a volume at this area, an increased volume at this area. This confirms our trade. Then we enter the trade. For a bullish breakout, you enter a long position when price breaks above the R1 region and retest on the new support area. Then in a bearish breakout, you wait for price, you enter a short after price breaks out from below the support 1 region and retest the new resistance. So for this buy situation, we wait for price to break out from this resistance area from the resistance 1 area. As you can see at this area, price broke out from the resistance 1 area, came back to retest, and it retested the support 2 at this area. This would have been a good opportunity to enter a long trade. But we don't just enter a long trade, we enter a long trade after we have seen our reversal signal. And this would have been a good signal after we've seen our bullish candle. We can actually use the lower time frame to capture a bullish engulfing candle, which we will see at this area. You can also enter using this hammer candlestick pattern at this area when price came to retest the support 2 region. This would have been a good trade for us to capitalize on. Now a selling trade when price has broken and retested, it broke down the support region and it has come to retest. When price broke down, as you can see in this area, price, this was the last support region. If you analyze your chart well, you see this is the last support region, and we notice price broke below this side. When price broke below this side, we waited for price to retest. Even before that, we would have seen minor breaks of structures at this area, further strengthening our new bearish move. We wait for price to retest the resistance 2 region. When price retested the resistance 2 region, we would enter after the engulfing pattern. Place our stop loss just above the resistance 2 region or the previous swing high region in a sell trade. In your buy trade, you set your stop loss just below the previous support region on that area, so that you will ride the momentum to the downside. And this is me taking a trade, managing my take profits using either a trailing stop loss, or you can aim for a previous support region in a sell trade. You aim for a previous support region in a sell trade using this method, or you just trail your stop loss and exit the moment you notice a reversal signal. Your buy trade, you aim for a previous resistance point in the market, which will give us a 1:2, or you can trail your stop until you see a reversal method on the chart, a reversal candlestick on the chart. This will signal for you to exit that trade. Now, how do we manage our trade? As price moves in our favor, we move our stop loss to break even after reaching our first target. So your first target can be the first resistance point in terms of a buy trade or your second resistance point, depending on however you choose to identify your first and second target. Now you can also use a trailing stop using the next Fibonacci pivot level to lock in profits while allowing room for further movement. At this area, you can place your stop loss. When price moves in your favor, you trail your stop loss by putting them below around the area of the next Fibonacci level in price. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.